studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
In this section, we examine a question that many owner-managers ask at tax time. Can I personally claim employment expenses on my individual tax return? While the answer may sometimes be yes, the rules are much stricter than many business owners expect. A common misconception is that simply working for your own corporation automatically allows you to deduct employment expenses on your personal tax return. In reality, being both an employee and a shareholder does not create an automatic right to claim these deductions. Owner-managers must satisfy the same employment expense rules that apply to any other employee, along with carefully considering whether this is the most tax-efficient approach. To understand the rules, let's first compare a regular employee with an owner-manager. A regular employee may be able to deduct certain employment expenses if all of the CRA's conditions are met. These conditions are quite specific and are intended to ensure that only legitimate employment-related expenses are claimed. An owner-manager, however, has an additional consideration. Because they control the corporation, they often have the ability to decide whether the corporation should pay the expense directly or reimburse them. In many situations, this flexibility means there are better tax planning options than claiming the expense personally on the individual tax return. Whenever an expense is being considered, the first question should be whether it is an employment expense at all. The expense must be incurred because of the individual's employment duties rather than for personal reasons. Simply paying an expense does not automatically make it deductible. One of the most important requirements is the T2200 form, which is the Declaration of Conditions of Employment. This form must generally be completed and signed by the employer to certify that the employee was required to incur certain expenses as part of their employment. Without this supporting documentation, many employment expense claims cannot be made. The expense must also be an actual expense that the employee personally paid. Estimated amounts or unsupported claims are not acceptable. In addition, the employee cannot claim expenses that have already been reimbursed by the employer. If the corporation has repaid the employee for the cost, there is generally no remaining deduction available on the employee's personal tax return. Proper record keeping is equally important. Receipts, invoices, mileage logs, and other supporting documents should be retained for every expense claim. These records provide the evidence needed if the CRA reviews the return and asks the taxpayer to support the deduction. Finally, every employment expense claim is subject to CRA review. Even if an expense appears reasonable, the CRA will examine whether all legislative requirements have been satisfied, whether the documentation is complete, and whether the expense was genuinely incurred as part of employment. The most important lesson from this slide is that owner-managers should never assume they can automatically deduct employment expenses personally. The deduction depends on satisfying specific CRA requirements, maintaining proper documentation, and carefully evaluating whether claiming the expense personally is even the best tax planning strategy. In many cases, having the corporation pay or reimburse legitimate business expenses directly may provide a simpler and more tax-efficient result. Before an owner-manager or any employee claims employment expenses on a personal tax return, the Canada Revenue Agency requires several specific conditions to be satisfied. Many taxpayers focus on whether the expense seems reasonable, but in practice, most claims are accepted or denied based on whether the required conditions and supporting documentation are in place. The first requirement is that the expense must be required by the employment. In other words, the employee must have been required to incur the expense as part of performing their job duties. If the expense is optional or primarily personal, it generally cannot be claimed as an employment expense. Next, the employee must normally have a completed and signed T-2200 form from the employer. This form confirms that the employee was required to pay certain expenses as a condition of employment. It is an essential piece of supporting documentation for many employment expense claims and demonstrates that the employer acknowledges the employment conditions under which the expense was incurred. Another important rule is that the employee must have personally paid the expense. If the corporation or employer paid the expense directly, or later reimbursed the employee, there is generally no remaining deduction available to claim on the employee's personal tax return. Employment expense deductions are intended only for expenses that remain the employee's own financial responsibility. Proper documentation is equally critical. Receipts, invoices, mileage logs, travel records, and other supporting documents should be maintained for every expense claim. Without adequate records, even a legitimate business expense may be denied because the taxpayer cannot demonstrate that the expense was actually incurred or that it meets the CRA's requirements. Let's now look at some common examples. Expenses that may qualify include the business use portion of vehicle expenses, eligible business travel, office supplies, professional membership dues, and in certain circumstances, home office expenses. Each of these expenses has its own detailed rules, and simply falling into one of these categories does not automatically make the expense deductible. On the other hand, certain expenses generally do not qualify. Personal living expenses are never deductible simply because the taxpayer owns a business. Expenses that have already been reimbursed by the employer cannot be claimed again. Capital purchases, family expenses, and unsupported claims without proper documentation are also common reasons for denied deductions. This brings us to one of the most important concepts on the slide: the level of risk associated with an employment expense claim. When every CRA requirement has been satisfied and the documentation is complete, the claim is well supported and much more likely to withstand a review. If some documentation is missing, the claim may still require additional evidence before it can be accepted. However, if the required conditions are not met or the records are incomplete, the taxpayer faces a much higher risk of reassessment, interest, and penalties. In practice, many employment expense claims fail not because the expense itself was unreasonable, but because taxpayers overlook one or more of the CRA's technical requirements. Missing receipts, incomplete mileage logs, an unsigned T-2200, or claiming reimbursed expenses are all common reasons why otherwise legitimate claims are denied. The key takeaway from this slide is that claiming employment expenses is not simply about spending money for work. Every claim must satisfy the legal requirements, be properly documented, and withstand CRA scrutiny. For owner-managers in particular, this careful analysis is essential because, in many cases, there may be more tax-efficient ways to deduct business expenses through the corporation rather than claiming them personally. This final slide brings together the entire discussion on employment expenses and shows how tax professionals approach these situations in practice. Rather than immediately asking whether an expense can be claimed personally, experienced accountants begin with a different question. What is the most tax-efficient way for the business to pay this expense? The decision starts by identifying whether the expense is a legitimate business expense. If it relates directly to operating the business, the next question is who should pay for it. Should the corporation pay the expense directly, or should the employee pay it personally and attempt to claim an employment expense deduction? In many owner-managed corporations, allowing the corporation to pay legitimate business expenses directly is usually the preferred approach. Because the corporation is carrying on the business, it can generally deduct qualifying business expenses in computing its taxable income, provided the normal tax rules are satisfied. This approach also avoids many of the additional conditions that apply to employment expense deductions. If the employee pays the expense personally, a completely different set of rules applies. The employee must satisfy all of the employment expense requirements, including obtaining a completed T2200 where required, ensuring the expense was personally paid and not reimbursed, maintaining detailed documentation, and confirming that the expense qualifies under the Income Tax Act. Only then may a deduction be available on the individual's personal tax return. This is why professional tax planning always considers the overall picture instead of looking only at one tax return. A deduction that appears beneficial on the personal return may actually create unnecessary complexity if the corporation could have paid the expense directly in a much simpler and more efficient manner. A CPA plays an important role in this planning process. During the year, the accountant helps determine how expenses should be paid, reviews receipts and supporting documents, ensures the appropriate tax rules are followed, and evaluates whether the corporation or the employee should bear each expense. This proactive planning often prevents problems before the tax return is even prepared. Several best practices should always be followed. Whenever possible, legitimate business expenses should be paid directly by the corporation. Complete receipts and invoices should be retained for every expense. If an employee initially pays a business expense personally, an accountable reimbursement from the corporation may often provide a better result than claiming an employment expense deduction. Careful record keeping and professional advice remain essential throughout the process. There are also several common mistakes to avoid. Never attempt to deduct the same expense twice by claiming it personally after the corporation has already deducted or reimbursed it. Personal expenses should never be claimed as business expenses. Employment expense claims should not be made without the required supporting documentation, including a T2200 where applicable. Finally, poor record keeping can turn an otherwise legitimate deduction into a reassessment during a CRA review. The planning process itself is straightforward. First, identify the business expense. Next, determine who should pay it. Review the applicable tax rules. Document the expense properly. Prepare the appropriate tax return, and maintain complete records in case the CRA requests supporting information in the future. The key takeaway from this section is that successful tax planning is not about claiming every possible deduction personally. It is about choosing the most efficient method of deducting legitimate business expenses. In most owner-managed corporations, having the corporation pay qualifying business expenses directly is often simpler, creates fewer compliance issues, and produces a more efficient overall tax result than claiming employment expenses on the owner's personal tax return.